You think you're really objective enough to to identify the rocks that are your blind spots. The blind spots are what your rocks need to be, what's in those. So you need a way to shine a light on those blind spots and get out of your comfort zone and pick the weakest areas first. It's uncomfortable. Nobody likes to go to the areas where they know they're weak. Right? Business owners always treat revenue as an input into the company. It's not an input, it's an output. If they do all of the things properly inside the company and they have the right infrastructure and all the right systems and the right strategies, the right business plan, strategic plan, and they're executing it, the revenue will come to them because they have the right messaging, the right brand positioning, the right marketing, all of that. The revenue will come to them.
All right, welcome to this week's episode of The Freedom Experience. As always, I'm your host, Jean Moncrief. Today's guest is Ken Sangenario. He's the founder of CVM, creator of the Value Opportunity Profile, and the lead instructor of the Certified Value Growth Advisor program. So Ken's the guy basically who investors, banks, and private equity firms would call in when a business was days away from missing payroll. They'd fly him in sometimes with less than 48 hours to figure out if the company would be saved or if it was just time to shut it down. And for nearly 2 decades, Ken served as a turnaround CEO or the chief restructuring officer. And he'd take over companies under extreme pressure, find the root causes as quickly as he could, and then map a path forward. And along the way, he built a very rare skill, the ability to spot blind spots and structural weaknesses long before they became existential threats. So today he uses that experience to help business owners unlock the hidden value and double or triple the company's worth and build businesses that aren't just profitable, but are sustainable and transferable. They are built to last. So I guess, in summary, his work's about one thing: showing owners how to double or even triple the value of their companies without chasing that endless revenue sort of target or stream or mountain that you're trying to climb. In our conversation, we get into the patterns that he's seen after decades of turnarounds, how most owners are just one shock away from distress, and why building a sellable company takes years, not months. Ken shares all of these real-world lessons on creating sustainable, transferable value, and how chasing revenue without building the right foundation is a trap that so many of us business owners just fall into. I know it happened to me. It was the same thing. Chase 5, 10, 15, 20 million, and then you ultimately find out the business isn't worth what you thought it was worth. So Ken and I talk a lot about that today. And I think this episode is going to challenge how you think about growth, value, and what it means, or what it really means to build a business that can live beyond you, and that's an asset, and that's built with intention. So super excited. Let's get into it with Ken. Ken, welcome to the show. Thanks very much for coming on today. It's fantastic to have you here.
Thanks a lot, John. It's my pleasure to be here. Can't wait for this conversation.
Yeah, I'm really excited too. As I said before we started, I've heard you speak a few times, and I think you've got so much wisdom. I just wanted to get you onto the show and have a conversation with you and share some of your wisdom with our listeners.
Awesome. Let's do it.
Cool. So kind of starting out with that, I mean, you've been in this industry, and I'll let you sort of talk through what you're doing right now, but it goes back about 4 decades almost, 18 years. You've been around a while. I guess you've navigated some of those ups and downs that we sort of all talk about. I know for myself, went through the dot-com boom and then went through 2008 and COVID and whatever, but you've seen those ups and downs.
Right.
What I was really curious about is your time, 18 years, and you may still do that now as a turnaround expert and kind of dropping in. Maybe if we just start there and talk through some of that kind of work you're doing.
Perfect, because that really formed the foundation for what I've been doing for the last 15 years. And interestingly, and I was just describing this to somebody last evening, that most companies, private companies especially, that's where we work with primarily private, lower middle market and middle market companies. And most of them are this far away from a turnaround. Even if they're relatively healthy, even if they're not distressed, it only takes one shock to the system, to the company, to the industry, to their economy, to the economy, to push them over that limit to the point where they start becoming distressed. So what I did for 18 years really did form the basis for everything that I've done since then. And it started quite by accident, that those years, because some of those years were as a turnaround CFO for companies that were deeply distressed. And the very first one was, it was an accident. I didn't know the company was distressed. It was sort of a privately held, it almost was like it was a public company, but it was almost like a private equity firm. So it was a publicly held company that had a portfolio of disparate businesses. And they had a lot of capital that they had raised through way back in the Michael Milken days. So they had raised junk debt to go acquire a bunch of companies. And the idea was, we're going to keep growing the portfolio. So I thought, to me, it was like an ideal sort of segue from my public accounting days into the private corporate world, or public corporate world. And I thought it would be really interesting, but I quickly realized that the company was deeply distressed. And a lot of their portfolio companies were underwater, and they were in technical default on some publicly held bonds and so forth. So that initially I thought, I should turn and run for the hills. This is not what was represented to me. Right?
I'm out of here.
I thought, well, okay, maybe I can learn something here. So let me stick around for a while. I'll stick around for a year and see if we can clean this up.
Yeah.
Well, it turned into a 3-year-long, absolutely grueling turnaround and workout. And there were about a dozen entities involved that the company owned. And it was a public, technically a public company, more publicly held on the debt side and more closely held on the equity side, but they had one very publicly held subsidiary. And so that caused a lot of additional complications in the whole thing. But it was I learned a ton. They brought in a couple turnaround experts who became mentors of mine during those 3 years. So I did all the legwork. I did all the actual work. They guided me, basically. And so, but they taught me the art of turnaround. And from there, I went on intentionally to work for the next 15 years in turning around distressed companies, and had a practice of my own. I was the CFO for one other company following that initial one, for a private equity-backed company that was distressed, and that took some time to turn around and recapitalize. And then I moved on and became a turnaround consultant. I had several partners, and we would be brought in by private equity firms or bank workout groups to literally take over the company for 6 to 18 months full time. So I would come in as a turnaround CEO or chief restructuring officer, take over the company, develop and execute a turnaround strategy, and then either sell or recapitalize the company on the back end. So we did that. I did that for many, many, many years, and I learned a lot during those years, obviously. But I also, I learned a lot about the art of negotiation, the art of the turnaround itself, the strategic elements, the infrastructure elements, how to find where the root cause problems that caused the company to go into distress, how to find those problems very quickly, because often I would get a call on a Wednesday or a Thursday from a private equity firm, and they'd say, well, can we have this manufacturing company out in the Midwest somewhere, and they're telling us they're not going to make payroll next Thursday.
And you're jumping on a plane and
we need to decide whether to fund it or shut it down. So can you be on the ground no later than Monday morning and let us know by Wednesday whether we should, so I'd have to jump on a plane like the next day or two, and then very quickly be able to identify where the root problems were in the company and whether they could be fixed and how long it would take and how much it would cost and what the future would hold for that business if they could fix the problems. And so you learn very quickly how to get your arms around the issues of the company and really dig in and get to the root problems. And once you go through that process, you never look at a company quite the same way again, because you're always sort of immediately trying to figure out where are the constraints in this business. Even if it's a healthy company, every company has constraints. Every company has blind spots and weaknesses. And so those years of turnaround training really hones your skills to be able to always look at a company from the perspective of what's holding this company back from being everything that it could be.
Yeah.
Even if it's relatively healthy, which most of the companies are that we work with now, they might be stuck. They might be a little stuck. They might not be performing at peak levels, but they're not distressed necessarily. But if we can go in and find out or figure out quickly where are the root issues that are their blind spots and constraints that are holding them back from their full potential, well, that's huge, because most companies, we find private companies could double or triple in value over a 3 to 5 year period, 2 to 5 year period. So
I'm curious. I mean, you must see some patterns in those root causes.
Absolutely,
I mean,
yeah.
What are some of the things that you're seeing? I mean, you were talking earlier about companies almost living paycheck to paycheck came to mind. There's so many, and we're going into this economic, or feels like there's a bit of an economic crisis at the moment. What are those underlying root causes that you're commonly seeing, and what should we be watching out for right now?
It's interesting because there are patterns. The pattern depends on the background, typically the background of the owner or founder or the CEO who's ever running the company, and knowing what their strengths are. So if it's a manufacturing company and it's run by the founder, and the founder got into the business because they figured out how to build a better mousetrap.
Okay.
Right.
Yeah.
So they're going to be probably strong in operations because that's the area that they come from. But the other areas of the company are what gets them into trouble, because they don't know how to run the other 80% of the business. Their expertise typically is only 10 or 20% of running the company, and that's where they focus. And the other areas, kind of the natural opposite area. So if somebody is strong in operations, they might be weak in leadership. They might be weak in finance. They might be, right? And so we look at 8 primary functional categories of every company, and they all have to be strong and in balance with each other because they all impact each other. So if the owner is strong in 1 or 2, but weak in the other 5 or, the other 6, then the company is going to have constraints, and those are blind spots. And it's outside of their comfort zone, so they tend to not want to focus on it. So they'll keep trying to make that. In that example, the owner might want to keep making operations stronger, investing in more efficient operations. I had one client that sticks in my mind when I describe it this way, because it was exactly that. The owner was an operations guy and wanted to keep investing in equipment and automation and so forth to make the operations practice more efficient. It turns out the problem was nowhere. It wasn't in operations at all. It wasn't in the manufacturing floor. It was in engineering, which was not his strength. So, but that took a trying to figure out how to go all the way back through the process, back to the very beginning, and what went wrong and why. And so
one of your, I guess one of those is going to be people, one of those 8.
Absolutely.
I mean, you're the business owner, you're strong in a particular area, but you're either not bringing the right people in, or you're bringing people in who are sort of under you, or you'll deal with it yourself.
Mini-me's. They bring in mini-me's.
So it's finding the right people, I guess, is one of those. What else have we got in those 8?
So the 8 categories are planning, which is usually a big gaping hole for most companies. They don't do planning.
I saw a stat of like 5% of companies actually put together a plan and go and execute the thing, which is it was mind blowing. Probably
5% put a plan together. It's even fewer that actually execute.
So planning, people.
Planning, it goes planning, leadership.
And
leadership has to do with the team, but it also has to do with communication and culture building, all of that. So planning, leadership, sales, marketing, people, operations, finance, and legal. Those are the 8 primary functional categories. And they're actually rooted in behavioral analysis. So they're rooted in, you may have heard of DISC, which is a behavioral profile system.
Yes.
So DISC, if you think about the DISC, right? Dominant, influencer, supporter, and compliant.
Yeah.
Right. So the planning and leadership are in the dominant quadrant. Sales and marketing are in the influencer quadrant. People and operations, which those are systems in a company, those are in the supporter quadrant, and then finance and legal are the compliance quadrant. So you need to have all 8 of those primary categories in place, fully developed, in balance with each other in order for the company to reach peak performance. Weaknesses in any one of them, those represent the weak links in the chain. Those are the constraints to supporting growth. And if companies have weak, and we usually will assess the 8 categories and score them and then graph them so a company can see where are our weakest points. It's like the theory of constraints.
Yeah.
If you've ever read the book, The Goal by Eli Goldratt, right? It's the theory of constraints. So the weakest area will be the weak link in the chain. If the company continues to grow, which is where a lot of my distressed clients came from, they can grow, they could sell, they might even be able to manufacture, but they don't have the infrastructure to support. So they might be weak in some of those system categories. And the more they grow, the more pressure they put on the weakest points until those weak points start to become fail points. Mm-hmm. And then the company starts to implode. And it breaks down. You start getting customer problems, supply chain problems. Then the people inside the company start finger pointing. Your culture starts to break down. There's a lot of blame going on. Profitability starts to wane, and the company starts slipping into distress, and it's a slippery slope.
So you spent 18 years dropping in, figuring out what these patterns are, how to get to the root cause of the issue pretty quickly.
Right.
And then be able to go back to whoever had sort of dropped you into this scenario and say, either this business is going to work or it's not going to work, and cut your losses. Yeah.
And you hate to say that.
Yeah.
But here and there, and I won't say there weren't many cases where that was the end result.
But
there certainly were a couple. So otherwise, it's a matter of how quickly can we stop the bleeding and stabilize the company. And then it's a matter of time is your biggest asset in those kind of situations. The more time you have, the more likely you'll be able to successfully turn the company around. So anything you can do to buy more time that's sort of one of the primary goals. You need to stop the bleeding, stabilize the company, and then a lot of times sort of shrink the business, retrench, figure out what the absolute core competency is, which is not always clear.
That's such a good point, yeah. To figure out what that core competency is and go back to that.
Yeah, and it's not always clear. I had one client that made very high-end handmade racing bicycles out of titanium, and they were absolute artisans at rolling sheets of titanium into bicycle tubes for the frame, and their welding was artistry. And I remember sitting with the private equity owner, and he was thumping his fist on the table saying, "We make the best bicycles in the world." And I said, "Well, respectfully, I have to disagree with you. You may, in fact, make the best bicycle frames in the world, but you don't make the wheels, you don't make the handlebars, you don't make the gear systems or the pedals or the right. You don't make any of that stuff. You just make the frame. So your core competency is not making bicycles. Your core competency is titanium fabrication, because you can fabricate titanium better than probably anybody else in the world.
In the world. Yeah.
That's your core competency. So how can we leverage that talent that you have? You have a whole plant full of artisans, and he just sat back. He was an elderly gentleman, and it just caught him off guard that somebody would disagree with him. But he
did you see the light bulb go off though, or did he sit back and okay, right?
And then literally about 6 months later, nothing that I did, but they ended up getting contacted coincidentally by NASA.
Okay.
And they ended up building the landing legs of the Mars rover.
Okay.
Out of titanium, and NASA had to buy heavier equipment to bend even thicker sheet of titanium, because much thicker. So they needed new equipment, but they So that was a perfect example of their competency not being making bicycles. They were good at making bicycles, no doubt, or bicycle frames, but that was just the beginning of what they actually could do. So
I feel like going back to what you were saying earlier, where business owners have this sort of competency themselves, where they're really good at something, and maybe operations, or you have a business that operationally is performing really well. Take that example that you're using right now, we're building titanium frames, but they're not kind of looking outward as much. They're looking inward more at how the business is running, and not taking input from their external environment and thinking about how they can evolve. And I feel like that's so important right now with sort of what's going on, and everything's up and down. Like thinking about that core competency and what might be possible, rather than just sort of this is what we do, hammer away at it. And I'm curious on your thoughts on that as well.
Yeah, it's amazing. Even now, so for the last 15 years, I haven't done those deep dive, take over the company kind of turnarounds. I've taken all of those skill sets and that knowledge and redeployed them to work with companies that are relatively healthy, right?
Okay,
but maybe stuck or maybe not reaching peak performance. But what I've noticed almost in every instance is exactly what you're describing. The business owners they're all about, I'll say, chasing revenue. They don't think about any kind of repositioning of their business or deep thinking about, hey, what do we do here that really is adding a lot of value to our customers, or could add a lot of value to other customers that we're not even touching yet? How could we reposition our skill sets, change our messaging in the market, our branding, our market positioning? How could we take advantage of some additional thinking, some clear out of the box kind of thinking? So that's a big piece of what we bring to clients, is forcing them out of their comfort zone to think beyond what they're doing right now and focus on maybe areas that they could be doing. A great example is a company. It was a contract manufacturer that we worked with for several years, and they had a really terrific engineering group inside the company. So they'd get these RFPs from customer prospects to say, here's the product that we're developing. Well, they would have their engineering team look at it as part of the bidding process, and the engineering team would come up with ways to improve the manufacturability of the product, and they'd give that back to the client, and then the client would, in a lot of cases, say, thank you very much, but now we have a lower price on the manufacturing from somebody else, so we're going to give the manufacturing to someone else, right?
Yeah.
Or they might give it to this company, but they're squeezing them on the price even. Yeah. And so I said, well, let me get this straight. the highest value that you can possibly add to a customer is this engineering skill set that you have. And you're literally giving it away, right, for the opportunity to bid on the commodity manufacturing business. Does that make any sense to you?
Doesn't make sense.
Doesn't make any sense.
Yeah.
So I go out to your customer, and you're doing this all through the buyers of the supply chain buyers of your customers. You need to get your relationships have to be higher. Get above the buyers. Get into the executive level of your customers. Let them know the skills that you have, the value that you can bring, and charge them a big premium for bringing that value. So business owner said, well, okay, I'm going to try it. So he literally a couple of days later, he goes out to a customer, an existing customer, and he says, look, we're going to start charging you for the engineering services. And here's the rate that we're going to charge for this engineering product. And then you can decide whether you want to give us the manufacturing or not, but the engineering is going to be separate. He came back and he said, the guy didn't even blink. He just said, fine.
You could have put it in for twice as much.
I said, so then double the price. Go do it again with somebody else and double. He goes out, he comes back, no pushback. I said, you got to keep going until you start getting pushback. Keep raising the price. They kept raising the price, and their engineering services became the primary profit maker of the company. Nice. And then they started getting no bid requests on the commodity manufacturing because the suppliers, they started saying, we'll only do the engineering if you'll give us no bid on the manufacturing. So they started getting those contracts. And then they went from, 9 or 10 million of revenue to 18 or 19 million of revenue, almost doubled their margins and ended up selling the company, at a very attractive
great multiple.
Yeah, multiple. So,
but before we started, we were talking about kind of my background in chasing the 5, 10, 15 revenue, 20 million.
Yeah.
And it's talking about creating value and like revenue and profits, the output, if you build that value properly. And that's what you're focused on right now with the people that you work with, right? Is how do we unlock that value in the business?
Value. The
revenue and the profits going to sort of come as a result of that. It's going to be out for that. Yeah.
Yes. Thank you. Absolutely.
I learned the hard way.
Business owners always treat revenue as an input into the company.
Yeah.
It's not an input. It's an output.
Yeah.
If they do all of the things properly inside the company, and they have the right infrastructure and all the right systems and the right strategies, the right business plan, strategic plan, and they're executing it, the revenue will come to them because they have the right messaging, the right brand positioning, the right marketing, all of that. The revenue will come to them. And so basically the growth becomes an output of everything else that they're doing, as opposed to the way most business owners go about it is they're chasing revenue. And they're thinking that if we can get enough revenue, then we can build the infrastructure, right? But that's backwards. You need to be doing all the right things so that you can attract the right kind of revenue, and you need to have a detailed filter system for the kind of revenue that you will take on, because most companies, we find when we look at the variety of revenue that they have, the variety of customers that they have, and they're all over the place because they just chase revenue. So they might take on projects that are a little too big or a little too small for them. They might underprice projects because they just want to capture some revenue. They might be outside of their typical geographic region a little too much. All of these different ways. They might do too much customization. We've seen like SKU creep in companies where they start off with 50 SKUs and they end up with 5,000 SKUs, and they have all this excess inventory sitting around because every customer wants it their way. And we're like, this is not Burger King. You
And then
don't have it.
the cash flow sitting on the shelf in the warehouse, basically.
Yeah, exactly. Yeah.
Where's all the cash back
Yeah.
there?
So we always try to help companies really refine the filter system that they're using to decide whether or not to even quote on requests for proposal, whether they want to accept new business that comes to them. Is it the right kind of business? Is it the business? Now, the wrong kind of revenue, it could have three impacts. It could not be profitable, in which case it really hurts.
Yeah.
And we see that too.
So often, yeah.
It could be profitable, but not value creating. So in other words, it could generate cash flow, but not create any value because it's not sustainable. It's not predictable. It's not a long-term relationship. It's just a one-off. So a lot of revenue that we see in companies might even be cash flow positive or profitable, but it's not creating value. In fact, even that will typically erode value because it's taking management's attention away from the kind of revenue that will create value, which is their core competency revenue. And then you have and it's okay, by the way, if companies take on business that is not creating value, if they take it on because they need the cash flow from it, I get that. And they can do some of that, but they have
plan.
to,
like
as part of a plan.
As part of a plan, yeah.
They have to be conscious that they're doing it and why they're doing it, right? So there has to be some intentionality to it, as opposed to that just being the habit that they've fallen into. And then, of course, the right kind of revenue is what really drives their value.
Yeah, I was thinking of a client that I worked with in the brake fluid industry, and kind of, I guess, similar to what you were talking about with the engineering folks as well, where they supply fluid to all of the big brands around the world, but they were supplying bulk fluid as well, low margins, yeah, something that sucked up time. And ultimately they decided, run it for a while for the cash flow, do what they were doing on that side, which is creating high performance fluid, but ultimately just kind of get rid of it. But there was an intention, there was a plan to what they were doing.
Yeah.
Be intentional, create the plan. I still go back to 5% of businesses have a plan. It's just unbelievable. And it goes back to, like, I think you were saying why most private companies fall short of being able to create that value. They just don't have a plan. They're not intentional about what they're doing.
Yeah.
And I guess when I think about the stats that we see now, where you see like 80% of companies going to market may potentially sort of never sell. They're either going to shut their doors or do whatever. And that's really where your focus is, right? Is helping these folks to kind of increase their value 2-3 times, I suppose.
Yeah. I mean, we find that private companies, in most cases, could double their value without any revenue or profitability growth. Think about that one. Yeah. We have a long track record of proving that to companies. And the way
it's worth repeating, isn't it? They could double their value without increasing profit or revenue. Is that
correct?
Yeah.
Yeah. And then the byproduct of that, because the way they do that, or the way we help them do that, is by building the quality of the company. So we're effectively working on the multiple by increasing the quality, improving the quality, those 8 primary functional categories, identifying where the weak points are and strengthening them, just like in the theory of constraints, the weakest links first until we get the company into balance, and then continuing to strengthen all 8 categories in unison, keeping the company in balance, right? So we're improving the quality and reducing the risk. It's called company-specific risk. So we're reducing the risk. And the risk of those weak areas has a huge impact on the value of the business. So that's why if a financial buyer like a private equity firm comes in and they're acquiring a company, in due diligence, they're identifying all of these areas of weakness. And then they're figuring out how much we're going to have to additionally spend to bring this company up to par, up to where it needs to be, to improve the quality. So the buyers are capturing all of that value, that doubling of value. Typically, the buyers are capturing that, but they're figuring out how much we're going to have to invest in time and energy and resources to get that to happen. And we're going to take a multiple of that off of the value of the company, because that's our value that we're going to capture, right? So we say, well, to the owners, we can help you capture that. Why leave that on the table?
Yeah.
You can capture it. It will take a couple of years, 2 to 3 years, but we can double your value. And then the byproduct of that is they will naturally get the revenue, the output, the revenue increase, and the margin expansion and profitability expansion. And that's where the tripling comes from. And that usually takes 3 to 5 years to get the triple impact. But it all starts with improving the quality.
And this is probably something that most business owners are either leaving too late or not just not thinking about it.
Right.
It's going to take 3 to 5 years.
Yeah.
But you can massively increase the value of your business. And I think you talk about the 8 sort of subcategories, but the top 3 are sustainability, predictability, and transferability. And
yes,
can get the business more sustainable, get everything more predictable, and make sure that it's not, I guess, over reliant on the owner.
Yes. Yeah.
Like if you just think of those top 3 level things.
That's right.
That's where it begins.
That's where it begins. And yeah, absolutely. And most businesses are very owner reliant.
Yeah.
And they don't understand. They think that if I decide I want to sell this year, I just have to make that decision and I'll sell it and I'll have plenty of money to support my post-transaction lifestyle. And then they get a rude awakening that the business is only worth a fraction of what they thought, because it's 100% in their heads, right? They're the expert. They control everything. Nothing's documented. There's no plan. Nobody else can step in and run this company without them. So where's the value?
Yeah.
The value is all, they're the value. And when they walk out the door, the value walks out the door. So I've had to tell companies at times. One client said to me, I started this company 30 years ago. We've been profitable every year. I should be able to sell this at a premium, right? I spent the day with them and I came back and I said, look, if you sell this company, it's really only going to sell as a, basically for the value of your equipment and your building.
So net asset value.
It's just an asset value,
yeah.
Because all the intellectual property is in your head. You haven't taken any time to institutionalize that knowledge or to build a team that can run this company without you. So unless you want to work for somebody else for 5 years, which I knew he didn't, this will be just a commodity sale. There's no premium here.
I mean, I feel like there's a lot of sort of shenanigans going on in the industry at the moment. Before we hit the record button, we talked about Bo Burlingham writing the book, Finish Big, and that was my first exposure to the exit process about 15 years ago. It feels like when back then there were less searches on exiting and more searches on startups. It feels like things are kind of flipped a bit. You've got acquisition entrepreneurship, no money down stuff. A business owner who's thinking of selling, probably the first thing they need to do is pick up the phone to a broker or whatever. What's some of the advice for business owners now? Because things have changed a lot.
Yeah.
And I feel like there's a lot of kind of unscrupulous folks out there at the moment. I mean, there's some really good people, but trying to kind of pick up somebody's hard work for next to nothing. And where does the business owner, I'm curious about your thoughts on where they start to kind of figure this out if they're thinking of going through the exit process?
We always suggest that they start by having an assessment of their business conducted for them so they can understand. So what happens is business owners right now, owners will decide they want to sell. They'll call a broker or an M&A advisor. somebody will take them. A lot of times they get turned away. The intermediary knows that they're not ready.
Yeah.
They'll turn them away. But somebody will ultimately take them, because there are brokers and M&A advisors who are desperate for deals, right? Because they live and die by the transaction success fees. So somebody will take them to market. They might even get some offers, because they'll put together sort of a shiny book, right? That won't identify all of the issues in the company. And often the broker or the advisor they're not even aware of the issues, because the owner's not aware, and they're relying on whatever the owner's telling them to write the book.
And the pretty picture that the owner's painting goes back to what you were saying earlier.
Exactly.
Yeah.
So they might even get an offer, an LOI, and subject to due diligence, of course. And then due diligence, I call it the due diligence slaughterhouse. They get into due diligence, and that's longer and deeper now than it ever has been, primarily because of the accessibility of information, right? They can just keep getting the systems now. The information systems just allow you to get down to such a level of granularity that the buyers will just keep digging and digging and digging until they uncover anything and everything that could possibly impact the value. And then the retrade comes where, oh, well, we'll still buy the company, but we didn't know that you had all of these issues that we're now going to have to fix. So they're doing the assessment that might take months. It might take them months to do all of their assessment. It's an assessment that, like we say, we can do it in a week, and then you'll pretty much know all of the issues that you're going to face in due diligence. But a buyer will drag it out for months. By that point, too many people have found out about the deal. You've owner
taken your eye off the ball.
The owner thinks, that's a great point. It's distracting to running the business, first of all. So the business very often starts suffering because they're not paying attention. And secondly, the owner thinks that the LOI price that he's had in his head, he's already told, or she's already told, they've already told their spouse and their family and their friends.
Mentally bought the Ferrari.
They've already mentally spent the proceeds. Right?
Yeah.
And then the retrade comes, and it's a third less than what, or half less than what the initial offer was. And by that point, the owner is they're too committed to the deal.
Yeah.
Too many people have found out. It would be too embarrassing for them to back out at that point. So they take this lousy deal often, and then they have seller's remorse. Immediately, they have seller's remorse. Had I known that this is how it was going to go at the outset, I would never have gone down this path, is what owners will say, right? So what we suggest is, instead of going through that really ugly, painful process, get an assessment of your business before you ever go to market. You'll learn all of the issues, or the vast majority of issues, that will come up in due diligence. And you'll also know the hit on value that you will likely take after due diligence is conducted. So that gives the owners the ability to make a much more informed decision about, do I still want to go to market right now, knowing what I'm going to face? Okay, if you do, and you're okay with the value hit that you'll take, at least you'll be able to have prepared responses for all of the issues that arise, right?
Yeah.
You won't look like a deer in the headlights, which most owners that's how they end up looking when due diligence starts asking them about all of these issues and they have no idea that they were issues, right? They look like they didn't have control of their own business. If they have an assessment up front, and now they can have prepared responses that can come across as a lot more knowledgeable, a lot more in control of the company, and they can explain, yes, I'm aware of this, and this is the plan we have to address that, and this is the timing, and this is right? They can explain it all and not take as big of a hit, and actually maybe even present it as an opportunity for the buyer to say, look, this is how much it's going to cost, and this is what it's going to involve, and you can do that, and this is the value that you can add. to the company, right? And so they won't take the whole hit. They might take some of it, but not all of it. But at least they'll be able to still sell the company for, somewhat of a reasonable price. Or they might step back and say, well, I don't want to take that big of a hit. Let's take a year or 2 or 3, and let's at least capture the low-hanging fruit here, the things that we can easily fix without a lot of capital outlay, right? And capture some of that value, and then we'll go back to market in a better position. And what often happens when they do that, they start working with them for a year, and then they will say, okay, it's been a year, you want to go to market now? And they'll be like, well, no, I've got
a leadership team, I've got good people, I've got systems in place, and I've got good cash flow.
We're having fun again.
We're having fun, yeah.
We're re-energized.
Yes.
And now we see the potential.
Re-energized, yeah.
Yeah, now we see the potential that we still have in front of us. We don't want to leave that all on the table. Let's go for another year or 2. Let's get up to another level and another level. And then they get really hooked on it, and it totally transforms their businesses because it changes the way that they run the company day to day. It changes the way they make decisions. They get a whole decision-making filter system that they can push down through the organization so everybody understands how to make decisions. The owners can very often then sort of get up out of the weeds and let people that report to them make decisions more autonomously, because the people will be trained and they'll buy into the plan that the company has developed.
Back to the plan, right? Yeah.
Back to the plan.
Back to the plan.
And very clear mission, vision, very clear values, very clear objectives. So everybody buys in. Everybody in the company then understands how they fit, how they're adding value, what their position is in the overall driving of the plan. And it gets a lot more engagement throughout the whole organization. Everybody is now rowing in the same direction. There's a lot more excitement, a lot more collaboration, right? It's just it's just amazing what happens.
But Ken, I'm curious, because this is a mindset change for the business owner.
Yes.
How many times are you going in where the mindset's not going to change? Because I think that's probably the biggest barrier here.
It very well can be. And so I've learned the hard way over the years too, to be able to assess the willingness and the capacity of the owner to have a mindset change. And if they're not interested, if they're not motivated by it, if this doesn't resonate with them, then we just step away. We'll back away.
And going back to what you were saying earlier about choosing the right revenue, the right customers, you're doing that in your own practice or your own business. Is this somebody we're going to have fun with? Is this somebody who's willing to change? Is this somebody who we can make a difference with? Yeah. As opposed to just sort of taking on anything, because then that sucks the energy out of you as well.
Absolutely. And we've had those early in this 15 years that we've been doing this, we've had clients like that because it never dawned on us that people wouldn't be willing to be open-minded about something. But after we had a few of those, we learned quickly how to assess the mindset of the owner before we take on the engagement, because it can be really painful for everybody.
Yeah. So you've taken all this years of experience and you've come out with kind of 3 core focuses, I guess. One is consulting or working with folks, but you've also developed some software. So you have advisory, education, and software, I guess.
Yes.
How does it all fit together, and how does the software?
Yeah. So the software came first, and that sprung out of my turnaround practice, because we were back in the 2008 and 2009 recession. My partners at the time, we still had our turnaround practice, and we were getting a lot of mandates from some of the large commercial bank workout groups.
Yeah.
So many companies were getting pushed into workout. And the workout groups, maybe I don't know if your listeners.
I was just thinking that maybe we kind of touch on workouts.
Yeah. So when a company has a term loan or a revolving line of credit, any kind of loan from a commercial bank, they usually have covenants
Okay. Yeah.
built into their loan agreements. They have to maintain certain levels of profitability, certain levels of debt service coverage, things like that. And when companies go through a recession and they start violating those covenants, not intentionally, but because their business has declined, they start violating the covenants. It makes the banks nervous. And if the company can't demonstrate that they can quickly change the direction of the business, the banks decide, well, we'd really rather get you out of the bank now. We don't want this relationship anymore. We'd like you to go find a new lender. And so they get pushed into sort of detention. They get put into the workout group. And the job and the role of the workout group is to each week tighten the screw another quarter of a turn on the company in terms of additional fees, raising the interest on the loans because they start applying like default level interest, things like that to sort of get the company to
squeeze as much out as we can,
keep squeezing them until it's too painful and the company gets out and the bank gets paid. So we would get, but the first step for the workout groups is to get a full understanding of the business and what the problems are and whether they think the company can actually change the tide. So we would get these mandates to go do an assessment of the business, and the mandate would be go spend a week or two in the field, assess the company, write us a report, let us know if this is a train wreck or whether we can put it on the back burner. Can it be fixed? If so, how? All of that. So we started doing a lot of these assessment engagements, but it occurred to me at the time that we didn't have a standardized process. My partners and I we each had a lot of experience. So we all did high quality work, but we all did it manually and we all did it in our own way. And our writing styles were all different. And the sequence of how we covered issues was all different from each other. And after we did a whole bunch of these, I said to my partners one day, I was like, look, we can't scale this business because we all do it our own way. We can't teach junior associates how to do this because we have all these different ways that we do it. And oh, by the way, we can't create a brand here because the bank might have 10 reports from us. Other than the logo on the cover page, they would never know these came from the same firm. Yeah. So we need a standardized practice, standardized approach. So I started developing an assessment software and thinking that I could develop it in a year. And within a year. And I wanted to have a valuation module built into it, and I wanted to have all these capabilities. Well, it ended up taking 5 years. It was supposed to cost like, I don't know, $40,000 or $50,000. It's cost like many hundreds of thousands of dollars. More than that. But it took 5 years to develop it, calibrate it, field test it, then get it rebuilt in the cloud and so forth. And it's been now in the market so along the way, I thought this is really too big for us to keep in-house. This is something we need to share with the rest of the advisory world and the business world because this can make a big impact on companies if we can show them an easy way to understand where all of their underlying issues are and weaknesses. So 5 years later, I launched the software. I left, started the company that I have now. My partners didn't want to invest in it. They wanted to keep doing it the way they did. So I left.
Okay. Looking at where the market's going, taking the external input.
Exactly. So it's been in the market now for almost 11 years, and it's a SaaS platform. So we license it to other advisors from CPAs to exit planners, turnaround consultants, financial planners and wealth managers, business valuation practitioners. So it's a pretty eclectic group of advisors. Anybody who's working as a trusted advisor with their business clients that wants to help the clients be able to create new value. And so what happened then was, and the software has come since that. It's funny because I look at the software now and I say where it is today, 10 years after we launched, it's so far beyond what it was the day we launched. We've continually added new features, new modules, new capabilities, all of these things, new industry-specific editions of it, and all of this stuff. But I look at it now and I say, this is way beyond anything I initially envisioned. But then I look at the product development pipeline that we have, right? And I say, what's on the product development pipeline is more than everything that we've done to date.
Yeah.
Right. So it's a never ending process, but it is a labor of love. People love the software. So we licensed that to advisors. What happened in the beginning was people started using it and they'd come back and say, well, we love it. Our clients love it. They love the reports. They love the insights. But now they want us to help them implement the roadmap that the report generates, because the report will say, these are the things that you should work on and in this sequence.
So these are the gaps that we talked about at the beginning, where if you're thinking about taking the business to market and you're thinking about selling it, kind of go through the process, get the report done, the assessment.
Yeah.
And then you've got the plan and you can start executing the plan. And you just, sorry, I cut you off, but you're saying there's actually a sequence.
Yes. We look, because again, going back to that theory of constraints.
Yeah.
It says these are your weakest areas, and within the weakest areas, these are the highest priority sub areas. So there's a whole sequence that it lays out in a roadmap, and it's typically a several year sequence. So it's not designed for the company to try to get it all done in 6 months or a year. It's a long term. It's a change in lifestyle, like as you mentioned. It's a change in mindset of how they're going to run the company. It takes time to make those kinds of changes and improvements.
And I'm thinking when you think of something like sort of EOS, where you're thinking of rocks or any of the growth systems, the leadership team or the owner and the small team are thinking about those things themselves. Whereas this brings some priority to what's actually really important from an objective view. Like,
yes,
I think that's really interesting as well. So you can actually take a look at what's coming out of the assessment and saying, well, actually, we should be prioritizing this rather than what we thought. Otherwise, you get stuck in these are the things that we think are important, but maybe not.
Yeah, I mean, that's a great point. And we've come across a lot of companies that are running on EOS, and there's nothing like I'm not taking a dig at EOS, because EOS isn't, by definition of their acronym, it's an operating system. It's a system of discipline and focus and execution and tracking and all of that, right? But I often ask owners, how do you develop your rocks, which is the front end of the whole system? If you have the wrong rocks, then the whole system breaks down.
Everything falls. You're not getting anywhere. You're
not getting anywhere.
Yeah.
And so usually they'll say, well, once a month, we go off site, the leadership team, and we spend a half a day or a day together and we talk about our rocks, and those become our rocks. And then we build a plan around those. Okay. So one client that's been a long time client now, when he first said that to me, he got introduced to me and he said, we've been running on EOS for about 3 years. We really like it, but it just doesn't seem to be moving the needle. And I don't know why. Like, what are we doing wrong? That was my introduction to this company. They've now been a client for, 8 years or so. And I asked him that question about the rocks, and he told me that answer. And I said, okay, so let me get this straight. There are 5 of you on your leadership team. 4 of you are plastics engineers. And then the 5th one is your CFO. Your plastics engineers, you and your plastics engineers, your passion is product development. You're developing some great products, a lot of R&D, right? And so that's where tell me what your rocks are. And their rocks were all around product development.
And the assessment was saying sales and marketing or something different.
They had no sales department. They had no marketing department. It was all about product development and operations. Okay, great. Do you think you're really objective enough to develop to identify the rocks that are your blind spots? The blind spots are what your rocks need to be. What's in those? So you need a way to shine a light on those blind spots and get out of your comfort zone and pick the weakest areas first. It's uncomfortable. Nobody likes to go to the areas where they know they're weak, right? People naturally like to focus on the areas where they excel.
Exactly.
Because it makes them feel good.
So we want to use that assessment to help inform what our rocks should be, or our priorities, or whatever system we're using.
It can be the front end of whatever system you're using. Yeah.
Brilliant. Love
and
it.
then people started asking us, just to finish on your question, and I'm sorry, I'll just wind me up and I'll just go. So people started saying, we don't know how to help them implement this roadmap. Can you teach us? We need to learn about all of these other functional areas, because most advisors have some sort of financial background, or they have some niche expertise. They might come from sales or marketing, or they might come from finance, or they might come from operations, but they might be a foot wide and a mile deep in their expertise.
Yeah.
But they're very thin, if at all, in their expertise on the other 7 functional categories of a company. So we created this Certified Value Growth Advisor, CVGA, training program, which is now we're coming into our 11th year with that now as well. And it's a very rigorous, it's become a highly regarded
program.
It's unique in the world. We have people that come from around the world to come to this program because they know they can't find anything like it anywhere else. It's content that it's experientially driven and developed. It's not from textbooks. It's not taught in any grad school or undergrad programs. It's not taught in any other certification program. But it does incorporate some elements from turnaround, from valuation, from exit planning, from all of these different knowledge bases, and it pulls them together in a way that really helps advisors understand the fundamentals of business across all of the primary functional categories. So they'll have a working knowledge. They still might not be an expert in everything, and they don't need to be, but they need to have a conversational level knowledge in all of the functional areas so they can identify and understand the issues and assess which ones they can help with, which ones they need to call in a subject matter expert to help with, and when. And then they can run the engagements over a long period of time and make that transformational change that the businesses are looking for.
So when somebody's engaging with one of those folks who've been through that certification program, through your program, they're actually engaging somebody who may have come from finance or may have come from sales and marketing, but is no longer just that kind of mile wide, inch deep kind of knowledge. Right. They've actually really have some substance to helping business owners navigate this challenge.
They have a lot more substantive knowledge about all of the functional categories, the issues that are typically there and hiding under the surface, and they also have a community of all of the other people, the rest of the people that have come through the program, because we have an online community where people can share issues, challenges, best practices. They can collaborate with each other. So they have a whole community of subject matter experts at their disposal. All they have to do is go on and plug in, hey, I've got a client that needs help with operations. Who can help me? And they'll get responses from the community of people, all of whom have been through our training program and using our software and that kind of thing. So it's a like-minded
community of people
who are very collegial and very willing to help each other, because everybody that's involved in this has the ultimate objective of wanting to make a difference in the business world. Because you started off by saying 80% of companies are not sellable today. And when you think about, 60 or 70% of those companies are baby boomer owned still.
Yeah.
And it's a scary thought to consider. I'll call it the economic freight train that's coming down the tracks right at us.
Because we're talking about communities, jobs and community. I mean, when that business goes, it's not just the business that goes down. It's the community, the people.
Yes. What will happen if those companies are not made to be transferable and they end up just shutting down, which you see a lot of companies, even right now, just in the last few weeks, you see how many companies are just shutting their doors.
Yeah, things are getting tough, and you're like, I'm done with this. Might as well just shut the doors, right?
Yeah, and when owners have been through the 08, 09, right?
Yeah.
And then they went through COVID again, and they had the big downturn then, and now they're facing potentially their third big downturn.
Uncertainty.
And they're thinking, I don't have the energy, I don't have the stomach for this again.
Yeah. But if you can dig deep and find that energy for sort of 12, 18 months and just find that energy, go through that assessment, go back to what you really caught. There's a massive opportunity here as well. Get it right now. Take the time. I think revenue doesn't have to go, profit doesn't have to go, but grow the value right now.
Grow the value.
And if people can go, the audience can go away with that right now. Yes, we're in uncertain, tough times at the moment, but now's the time to find that bit of that energy again and run the last marathon to build the value here. Yeah. And you come out the other side a much stronger business.
Much stronger. Exactly right.
Ken, I really appreciate it. I got one last question for you, actually.
Sure.
The podcast is all about freedom and entrepreneurial freedom. What does freedom mean to you?
Freedom, to me, I'm going to put it in the context of what's been my passion for the last, this has all been my passion, turnarounds and helping companies get unstuck and so forth for the last 30 years plus. And so freedom to me means that I've made a difference in the world. I've used the talents that I've been given, because these are some natural I've had to learn a lot, of course.
Yeah.
But I feel like I've been given talents that are unusual for some reason. And if I can feel good about having transferred those talents to so many hundreds or thousands of other people who can then touch tens of thousands of businesses and make a real difference for, as you said, not only for the owners of those companies, but for the communities that those companies impact. Yeah. And I don't have to be the one that's doing one at a time, one like spitting into the ocean by,
network effect.
Right. And I can then step back and feel like there is really a whole community of people that can now go out and execute this and make a difference. And I've been able to empower them to do that. That to me will be like
creating
a lot. I'll have a lot of personal freedom.
Brilliant.
From that.
I love it. So for those who, before we hit record, we were talking about our mutual friend, Ryan Tansom. And for those who want to take the red pill, we'll put all the notes down in the bottom. When it comes to choosing that red pill, all the notes, all the links through to your work. And I hope this helps some folks find their way to you as well.
Thank you.
All right, that's it for today's episode. Big thanks to Ken for joining me and sharing what it really means to build a valuable business. Some really different thinking there about being intentional about building a business and focusing on what matters in terms of building value and how profit and revenue are the outputs of that kind of focus on building the valuable things in your business. If this conversation got you thinking differently about growing your business, whether it's rethinking your priorities, strengthening your company's foundation, or building something that can thrive without you, then make sure to check out Ken's Value Opportunity Profile and the Certified Value Growth Advisor Program. I'll drop that into the links below. I think there's a training coming up at the end of November. Take a look at what Ken's got to offer there. If you need some help building value in your business, make sure to check out our programs down below as well. And then simply, if you're enjoying these conversations, please don't forget to hit the subscribe button and give us a rating. Ideally, 5 out of 5 would be brilliant. It helps us to find more business owners, entrepreneurs, and put the show in front of them. And it's going to help us to bring even more great guests your way. So thanks for listening. I'll see you again next time.